There is one line on your balance sheet that can quietly destroy your business. Most owners don't even look at it. Sometimes it doesn't feel dramatic or screams crisis, but when things slow down, it is the first place where damages show up. Today, I want to talk about the most dangerous line on your balance sheet and why ignoring it creates fragile growth. When business owners review financials, they usually focus on the revenue or the profit, which is the profit and loss statement or income statement. But as I've said before in previous videos, the balance sheet tells you a different story. It tells you what your business is built on. And there is one section that reveals whether your growth is strong or is very leveraged to the edge. And that section is called short-term liabilities. What are the short-term liabilities? That's the money you owe soon, in less than a year. For instance, vendors, credit cards, short-term loans, which are, line of credits, sales tax payables or taxes payables. So if the time change for your business, if profit slows down and you don't have enough cash flow coming into the business, that's when all your situation can look very dramatic. What is the danger here? The danger is the dependency on debt, not the debt itself, because you have the pressure to grow, and your business depends on those short-term obligations constantly, and they are always rolling over because your business doesn't have that flexibility. So if your business is very fragile, you will panic because you know for sure that you won't be able to meet those short-term liabilities. You won't be able to pay your vendors or pay your credit card. But if you have a strong business, you can survive those low months. And what is the line that shows that? First, current liabilities. So let me tell you a story. During the pandemic, most of business owners were in panic because there was a shutdown. We couldn't do anything, and restaurants and business owners got hit by this. And who were the companies that actually survived? The ones that have good cash flow or cash reserves in order for them to survive those slow months. So when you have those reserves, you're able to meet those short-term obligations that your business has, which gives you peace of mind. So why are the short-term liabilities good and bad? So think about this. You are going to build a house on a rented foundation. The land is not yours. The building is yours, but not the land. So from the outside, your house looks amazing. It looks solid. But if your land is taken away, then what's going to happen with your house? You're going to lose your house because that foundation is not yours. That stability is not yours. So having excess of short-term liabilities is like renting your land and building the house on it. So in my years working as an accountant, here are the patterns that I see. Growing revenue, but also your payables are growing, or they grow faster than your revenue, or your credit line is used for operating cash. For instance, you have to take out money from your credit line to pay your payroll. Another thing that I see often is you are covering one hole by opening a new one. That's a huge mistake when you are a business owner and you have projections to grow. Another situation that is very common is sales taxes or taxes unpaid because cash is tight. Remember, Uncle Sam, they always going to come to you and they're going to ask for their money. And the states are even worse. The states are sometimes, they don't care. Like they need their money and they're going to come after you. And last but not least, the owner's distributions. So you take out money of your business, but you are not paying your current liabilities, your short-term liabilities. So you are seeing profits in your books and you are basically looking profits but in your balance sheet, all this pressure is building up. So you need to make sure that you have a balance in your short-term liabilities and that you have enough cash reserves when you're growing in order for you to being able to pay those short-term liabilities in case things slow down in your business. And here is the paradox. The businesses that look more confident are often the most exposed. And when pressure hits, most of the times these businesses, they become reactive instead of strategic, because those short-term liabilities, they start to feel like really urgent. And now you don't have that revenue because that revenue was actually like that low revenue was actually hiding your structural fragility. So if you are pretty confident about your business, start reviewing your short-term liabilities and ask yourself the question, what if things slow down? Would I be able to pay these short-term liabilities, or should I take money from my own pocket to pay these short-term liabilities and jeopardize my personal life because of this? So what I've learned in my years working in the accounting realm is that when I review a balance sheet, I don't ask about how profitable are you. That's not even in the balance sheet. That's in the profit and loss. I always ask, if revenue slow down the next month, what are the obligations that will hurt your business first? If your answer is many, then you have a problem and it can become really dangerous. Remember that your balance sheet is not a compliance document. It's the pressure test of your business. It reveals the real picture of your business and it reveals the real picture of your decisions. I know it might sound tragic or exaggerated, but I have witnessed businesses collapsed overnight, just a couple of months, because their owners, they were reluctant to see the reality. And your short-term liabilities, they are dangerous because they are revealing the dependency that your business have in short-term debt, and that could end up eating all your cash flow piece by piece without you even noticing it. Most of the videos that I've watched from other peers, they talk about how you can fix your cash flow or how can you increase your profits and understanding your profits, but they are missing an essential or crucial element here. If you have a lot of short-term debt and your business for some reason collapses or slows down, then you will have to pay their price yourself with your own money, or you will have to close the business, which is not the idea. And the idea is for you to understand line item by line item from your financial statements so you can make better decisions. I hope this works for you and my information is really helpful. And if you want clarity and you don't want any pressures, subscribe to this channel because we are always talking about better decisions and not period reports.